Good morning. Welcome to YX Insights. Today is December the 5th. We're pre-market open and we're going to go through a comprehensive market update on equity indices, rates, crypto, gold, Max 7 stocks, and more. So we are going to kick off with this chart about liquidity. So on Monday, we had a market sell-off in both equities and crypto. And the news headlines, as well as many commentators, have attributed this to the Bank of Japan raising interest rates. The impact of high interest rate in Japan is a higher cost of funding for carry trades, where typically international players borrow money from Japan and lend it out or invest in higher yielding assets in the US. While this thesis has a lot of weight given the timing, I do think another significant factor is the month-end liquidity crunch that we saw in the interbank lending market. So this chart here is the SOFR versus EFFR spread. SOFR is the secured overnight financing rate. So this is the interest rate that banks lend to each other using treasury-backed repo. And typically, this is a much larger, more liquid market than EFFR, which is the effective Fed funds rate. So if you recall from the FOMC, usually the Fed sets a range and the actual trading rate is the EFFR, the effective Fed funds rate. It's unsecured, but also it has a very small volume in terms of market size compared to SOFR. So SOFR reflects the real liquidity conditions in a very deep repo market in the secured overnight lending. What we see is that SOFR shot up significantly above the EFFR. And you can think of this as that liquidity is getting so tight that banks are willing to pay for an extra Fed hike, over 20 basis points, to secure borrowing cash overnight. So collateral is in high demand, and there are signs of stress in the repo markets. And the downstream impact is that because liquidity is tight over the month end, there's less money going around into the more risky assets, into the broader market, such as equities and crypto. So I believe this month end dynamic triggered the Monday sell-off. And what we also observe is the Treasury General Account in this chart below, the TGA, has a big impact on market liquidity as well. Because of the government shutdown, the TGA, which you can think of as the US Treasury's bank account with the Fed, has gone up a lot over the past 2-3 months. And when the TGA goes up, it means money is sitting at the Fed, in the Fed reserves, and is not being spent in the real economy or moving its way into the markets. And that has a downward pressure on general market liquidity as well as the prices of risk assets. As we exit the shutdown last month, we are going to see a slow decline in the TGA as the government starts spending this money. And you could actually observe that when this TGA level is getting high, the SOFR versus EFFR spread widens. That means the liquidity is getting tight. Versus when it's declining, this SOFR versus EFFR spread actually comes back towards a more normal range in the mid single digits. So what we really want to see is TGA going down, money leaving the Treasury's reserve at the Fed, and moving into the bank reserves that would provide liquidity into the markets in the next couple of months. Looking at the S&P 500, the SPY ETF, before Thanksgiving, we had a fearful decline that was no more than 5-6%, but the market sentiment was very, very bearish. And that coincided with the whole TGA being at elevated levels, SOFR spread being quite wide, and credit spread also widening at the same time. Since then, we have found the first bounce towards the all-time high. So now we're inches away from the all-time high. Overall, the liquidity conditions are looking a little bit steadier. So the TGA has been in a small declining mode, going down from 960 billion now to 900 billion in the past week. So that's constructive. Credit spreads have also retreated a little bit from the low 9% range. And also there is a bit more market breadth now. So the percentage of S&P 500 companies above their 50-day moving average has gone up in the past week. So all of those signs are pointing to a more constructive picture into the year end. What I do think we'll find resistance is as we approach the all-time high, as you can see that we are in a slightly more consolidation mode this week, where things are moving in a very narrow range. The options dealers are hedging by buying the dips and selling the rallies. So that kind of dampens the moves that we see. And I do think once we get to this all-time high level, given the overall sentiment, there will be short sellers who start to try their hands again. And there will be people who want to take profit a little bit early before the year end and call it a day. So we could see some retrace once we hit this high level. But I don't think we'll get a massive pullback. We can see a retest of this upper trend line here, where there's a lot of volume being built around this 660 level. If this happens, I do think it will also happen quite quickly once we get a breakdown. But I do expect the area around 660 to hold before the next major rally into the year end for this wave 3 and potentially carrying into January as well. So my near-term target for the next couple of months really is to break above 700 and aim for this 715 level as a wave 3 target. I do think that's very realistic. And then once we approach a very seasonally weak February, the February, March, April period tends to be a bit more wobbly. We could see the next wave 4 pullback. But now we're getting a little bit ahead of ourselves. And from today, you will see a lot of outlooks for 2026 from the major banks who are going to predict SP 500 to move to some 1,500, some 1,700. And the way they do this is really simple. There are two components. First is underlying earnings. If S&P 500 earnings grow by 10%, even at the same multiples, you will see the S&P 500 moving up by 10% this time next year. So that's a very simple logic. But some will also predict that earnings will go a bit higher because of large fiscal spending, potentially high growth from AI productivity as we see those investments turning into tangible returns. Then we can see potentially 13 to 15% EPS growth, but overall liquidity condition could be a little bit tighter than today. So you assign a smaller valuation multiple, so the smaller PE to that, and you could arrive at a slightly lower figure than 7,700. So I'm just talking about the general framework, thinking from the fundamental side of how banks produce those earnings targets. So, and this is something you should bear in mind when you start reading them. It's not that they're doing technical analysis, looking at the chart levels. They are just mechanically calculating where they think the EPS growth is and what a reasonable valuation is given the overall macro conditions. Looking at QQQ, so QQQ is still a little bit further away from its all-time high than where SPY is. But very similarly, we are seeing quite dampened move in the past week. The option dealers are buying dips and selling the rallies, keeping things quite pinned. But I do think we could potentially try to attempt this all-time high and then followed by a dip towards this 600 to 610 level where there's a lot of volume profile. And I do see the near-term trend being broadly higher towards the year end as well as January. And I do think the mid 600, 650 is a very realistic target for the next 2 months in this wave 3. Looking at yields, so the market is split-minded about the December rate cut. Initially, the market didn't want to price in any rate cuts, and then we had some Fed speak, and then it looked a bit more optimistic that we'll get rate cuts. Now it feels more like a 50-50, so we still need a bit more clues ahead of the FOMC on which way they lean. To me, I think doing a rate cut is actually the safer option than not doing one. The jobs data, while they were constructive, only pointed to the labor conditions back in September. So it's quite outdated. And we have seen the labor market reports being revised downwards by dramatic amounts in the previous reports. So those constructive reports are actually not that reliable. And at the same time, unemployment rate did tick up as well in the household report. So I do think the neutral rate is lower than where we are today. The Fed admits this. And inflation is unlikely to be pointing further upwards from here. So I do think if they find a steady rhythm of rate cutting, is not a bad thing. They can always pause if the labor market data continue really strongly or CPI comes super high again. But right now, the default option should be cutting rather than pausing. So that gives me an overall bullish bias for TLT. So the TLT is the long-term Treasury bond ETF. I do think we can get above 90 or 93 in this wave 5 of 3. And we're now entering a more or less of a supportive region where we're at the lower end of this price channel, but also heavy accumulation volume over here as well. One thing you should watch out for is also the price of oil. So a lower oil price would reduce the inflation expectation, very heavily correlated to the 5-year and 5-year forward inflation expectations. And therefore, if oil goes lower, we will see yields going lower and bond prices moving up from here as well. My read is that oil prices should move lower from here in the medium term. It's been retesting this region around 70 to 73. It couldn't quite stay above it after trying the 50-day and 200-day moving average, and now it's getting rejected every time it tries this region. So I think overall, the bears are more or less in control here. I do think we could potentially get to a mid-60s and even low 60s in this cycle in the next year. Looking at Bitcoin, so there has been a big debate on whether Bitcoin has completed its 4-year cycle. So therefore, we are in for much deeper pain now. And that argument is very compelling because if you looked at the previous cycle's peak-to-peak action, it's almost precisely 4 years between the peak of 2013 in December and then December 17, and then 2017 to 2021, that's another 4 years. And here we go, 4 years later, we're in year end 2025. So if we follow this rhythm, we could have topped already. A couple of things do bother me, which is that the argument for this 4-year cycle is centered around the Bitcoin halving, because Bitcoin halving has a big impact on the supply of Bitcoin to the market. However, today, the great majority of Bitcoins have been mined, and therefore the halving of the supply doesn't really have a material impact on the market. And I would argue that institutional players, for example, the spot ETFs, are playing a much bigger role today than it did in the previous 2 cycles where they were basically absent. So I do think the market structure and dynamics have changed from there, and these cycles are more of a older school narrative. At the same time, there is a psychological barrier when we hit this point in time, because people who have been selling the OG whales who entered during the previous cycles and held until today, and they are willing to take profit around the 100K mark, but also they understand well the psychology of the 4-year cycle and therefore have timed their sales towards the end of these 4 years. So it's almost like a self-fulfilling impact that the narrative has on the market. But what is lacking is that we never really got this euphoria late stage retail entry into the market to complete the cycle. You see that not just in Bitcoin, the previous cycles, but you also see that in gold, where in the previous rallies, people literally lined up outside gold stores to buy physical gold. And that was actually near the top of gold's last rally. Similarly here, we don't really see a steep climb in the very last stage. And I do think that is a missing piece. And a lot of the selling was through liquidation of leveraged long positions across the exchanges, rather than institutional players really dumping all of their holdings. So we have seen outflows in ETFs, but not dramatically so compared to the amount of inflows we've had in the past 2 years. So there is some redemption, but they're not mass exiting the market. And actually, a lot of institutional players, instead of chasing up here, they had been patiently waiting for a 20-30% dip because they don't want to buy the highs. So I do think we could actually start finding support around this region here. And historically, gold has also led Bitcoin in terms of liquidity by about 3 months. And we have just seen a recent pickup in gold as well. So it doesn't feel like this market is finished just yet. I could be proven wrong if we get a much steeper sell-off from here. But my primary expectation is that even if we get a lower low, it wouldn't be materially lower than where we had in November. And we will likely see a positive bullish divergence on the RSI reading, meaning a higher low in this RSI, even if we get a lower low in Bitcoin. But right now, I'm actually quite optimistic that as Bitcoin breaks out and retests this trend line, there's a quite good chance we are actually in this wave 3 from this bottom here. So we're still in the early stages of this climb. We are in a slightly consolidation mode in the past 3 days. There's a lot of volume being here, and we're still under the 50-day moving average. So here, we still need to be cautious. Our machine learning signals are still risk off. But the broader picture does point towards a more optimistic near-term outlook rather than a doomsday scenario. For Ether, I think very similar. We are having a breakout of this trend line here, which is very constructive. Ideally, I want to see 5 ways south heading into the 3,800 zone where there's a lot of volume. And actually, Ether has managed to rise into the upper bound of this volume profile here, which is constructive again. But as long as we're staying under the 50-day moving average, we still have a chance that we can test a lower low. Very similar to my thesis on Bitcoin, if we get a lower low, I do think we will see a bullish buy-side divergence. We won't get a material dip beyond this November low. That's my primary thesis. So overall, I'm cautiously bullish for both Bitcoin and Ether. Solana, we had a couple of big rallies this week, but we are still below this trend line. Overall, I'm a bit cautious on Solana overall in terms of the bigger picture chart, but also even though the Solana technology is perhaps better than Ether in terms of speed, the big institutions, the likes of Goldman Sachs, Morgan Stanley, JP Morgan, BlackRock, they will be more focused on building tokenization on Ethereum rather than Solana. So when it tend to benefit from the great majority of the economics, for now, in terms of both the fundamentals and charts, I would require more evidence to get really bullish on Solana. Of course, you may disagree with me. Please leave a comment if you do, and we can discuss it further next week. Coinbase looks like a breakout and retest of this immediate trend line here. And it trades basically as a halfway house between Bitcoin and the Ether. So overall, the directions should be very similar. We are slightly struggling at this 200-day moving average, which is the red line. We've got above this heavy volume profile, which is very good. And so our next target is really aiming for the 330 region, where we get above the 50-day moving average as well as this volume profile here. There will be a lot of selling pressure when we come to this area here, because given the overall sentiment, I could imagine a lot of backholders who thought they could buy the dip over here, didn't cut the losses, and now they want to offload at break even. So that is something we need to be very mindful of, and we just see how the market reacts in this region. In terms of Robinhood, I am a bit cautious about how this chart could manifest overall. So the optimistic scenario is that we are in an ending diagonal for this final fifth wave, where each of the 5 waves are split into ABC up, ABC down, and then ABC up. So we could have had an ABC inside of this large degree A. And that would put this region here, where we're near the all-time high in the 150 region, as the target zone for this wave A. We get a pullback, and then we get a higher high towards 190 or even 200. So that's the very ideal scenario. But there's always this risk that, okay, maybe we did top in 5, because this is a fairly valid count on the ground scheme of things from the April low. So proportionally, you can't really say, oh, the 5 is shallow or anything. So I'm just keeping this risk in mind, but my primary expectation is we will get higher highs and in a ending diagonal fashion for the ultimate wave 5. So it's worth just watching closely at this stage how it evolves against our expectation. MSTR, to me, this looks like a flat ABC correction for this larger degree wave 4. MSTR now trades around 1.2x NAV. This is probably the narrowest region we've seen on the record, because institutions and retail players had chased MSTR all the way to 2x NAV, which did feel a little bit absurd. And now we have this multiple compression back towards the 1 level. Strategy is doing a lot of different fancy debt instruments as well. There's convertible debt, also preferred shares, and they have recently raised a dollar reserve fund for paying the dividends. So they are doing a lot of things. And of course, the theory is that either Marcus Saylor is an absolute genius with all this wonderful financial engineering, marrying a digital asset with a public company balance sheet as the pioneer of that, or he's just taking excess risk and everything will come crashing down, like 2000 dot-com bubble, in which Saylor did actually crash and burn back then. So the jury is still out there, but from a technical level, this wave 4 does look sufficiently complete at the 123% extension of this wave A from the wave B high, and we can start thinking about moving towards wave 5, and that could actually trade all the way towards 1000, which does sound incredible, but this type of multiples and this type of runs had occurred regularly in MSTR's recent history. Bitmine BMNR, very similar to Ethereum, we could have completed this ABC correction, and now I'm looking for a constructive 5-wave impulse up. And because we took out this wave 1 high, I'm getting more confident that we are moving towards this wave 3, and we could really find the resistance around this level, the 50-day moving average, with this volume profile of those who bought the dip over here, and now they're really annoyed at Tom Lee, and they want to get rid of it as soon as they break even. But overall, the picture does look much more optimistic than a month ago. SBET, similarly, we are looking at potential wave 3 higher towards the 200-day moving average and finishing all these 5 waves around 16 or 17, where there is significant volume profile. That could complete our initial wave 1 from this wave C low, and then we can get a retrace from this region back down here next. So this is actually the ideal scenario I want to see. And actually, that's not too bad. If you bought at the lows here and we complete the 5 waves, that's 50% higher than the lows. Looking at gold, gold has been a bit boring this week. We made past this wave 1 high, which gives me a bit more confidence that this is wave 3, although there is still a chance that this is just an ABC wave of a large degree B wave, and then we get a bigger retrace. That could always be the case. But for now, my primary expectation is we're going to move in 5 waves towards a mid 400 target in JLD. Apple has been in a very bullish uptrend channel, very constructive chart overall. And Apple typically does this during November to early December, during the holiday period, where the street is pricing in more bullish expectations for the winter sales. Plus, iPhone 17 has done a much better job than iPhone 16 did last year. So we are having bullish expectations going into the next set of earnings. What I did see is that this week we tapped into the wave 3 target region just under 290, and we've retraced from there. So all of this is well within expectation, which I've highlighted for a while. And now we're moving in wave 4. And this wave 4 could really test below 280 and even the mid 270s. That would make a 38% retrace of this wave 3. Pretty standard stuff. Potentially, there is a deeper retrace here to 270 because this wave 2 was really shallow. So the alternating theory is that wave 4 tends to be deeper if wave 2 is shallower. But overall, I do think we will get to 300 by the end of this bull run. And what could happen is that we reached 300 by the next set of earnings, and we get a sell the news situation after the earnings. Amazon, so this chart looks a little bit different to what I had before, because just looking at the overall dynamics, I do think this huge volume region here is an accumulation zone. And the pressure is actually to move higher towards 300 in this wave 5 of 3. And what I ideally want to see is we get a higher high here in this wave 1. It could all test all the way to the top of this wave 5. And then we get a pullback towards this high volume region, and then a higher wave 3 towards the 290s, towards 280 or even 290 next. I always find it interesting that the news headlines now reporting Amazon is making its own chips that is better cost effective than NVDA. They've been telegraphing that for a couple of years now because they want to offer the clients better cost performance chips, because not everyone needs the top-notch NVIDIA chips, given how expensive it is. A lot of clients only need reasonably high-performing but much cheaper budgeted chips that would suffice their jobs. Google, I do think we are going to see a wave 4 correction. And we have been moving sideways for 2 weeks now. We couldn't get past this 325 mark. So the path of least resistance is probably coming down towards the 51st. And we can even test maybe deeper below 270. Google has been a very bullish stock. It has more than doubled since the April low. But if you look at its valuation as well, so people think that Google is very attractive price, a very cheap stock among the Max 7s. But in terms of the 5-year history, Google is at the 2 standard deviation above its average, which means it's at near the peak valuation of its 5-year average. Last week time we saw this was 2021, and then we had a sell-off after. So I am a little bit cautious here. Of course, the earnings growth can catch up, which digests the valuation, but I think chasing here is not great risk reward. Meta. So Meta is a difficult chart because it does look like we topped back in August, and most of the companies didn't do that, the mid-high highs after. Looking at the price action over here, there is a very realistic case that we could be in this 5-way downward trajectory. And even yesterday's pre-market rally was sold off after the open, as it couldn't get above the 200-day moving average. So I may be wrong if we fill this gap, but right now I'm still very cautious. This could be a wave 4 corrective bounce, and we get a lower low here. For Meta, there is a more optimistic case where this is possibly an ABC correction, and we've ended the fall-off here. But looking at this, the length of this wave C is pretty long against this wave A. So that does make me just a bit nervous that actually this is not a wave C, but a deeper retrace, more like a wave 3. And then this is a wave 4 bounce. So that is how I try to interpret the chart. For Microsoft, the chart is quite difficult because we really have a very strong resistance band in this region. And that used to be the support. There's a lot of volume here, and there's a 50-day moving average. So this is a big confluence region where Microsoft really has to rally through before we can get decisively bullish. So my expectation is actually we try this 50-day moving average and we come back down for a wave 2 retest before moving higher in wave 3. I don't think we topped over here or over here for Microsoft. I do think we should get one more high structurally from the way this chart looks from the April low. But if we get a lower low, significantly lower low here, my thesis could be invalidated, and we need to start looking at the bear market expectations. For now, my bullish thesis remains. NVIDIA. So NVIDIA, I actually have a more cautious view because structurally speaking, those 5 ways do look sufficiently complete. Of course, you could argue this could be a 1-2 setup for a higher degree with 5, but this, at least the length of this rally suffices all of the 5 waves. And here we are. We had ABC correction down here, and now we're trying to get back above the 50-day moving average. So my caution is that this could be a corrective B wave rally, meaning it's a bull trap if you bought here, and we could have a lower low here. So that's my main thesis right now, given the completing picture over here for the 5 waves. And what I suspect is the semis ETF could rally to new all-time high with this, without NVIDIA necessarily making a new all-time high itself. So this remains on watch. And of course, I could be invalidated if we could get significantly higher above the all-time high. And then we are actually then looking at the much more bullish option, which is this is a 1-2 setup for much higher wave 5. In that case, we could have a really big blow off top in the next year. And then you can still make a lot of money anyway. But I think it does pay to pay attention at this moment. So for Tesla, we're back to near this high now in almost a very direct fashion, breaking above this volume profile as well as the 50-day moving average. So I have tentatively removed my 5-wave count potential because we just want to let this wave 1 breathe and see how high it can take us, and then think about the next drawdown before thinking about the overall big picture. So of course, if the higher this wave 1 goes, the higher our overall target goes. It could stretch towards 600. One thing I would mention is that while Tesla doesn't really trade on existing car sales in terms of valuation, because it's not valued as a car company, more of a robotaxi physical AI company at this moment. The valuation is now back. So we surpassed this December 2024 high in terms of valuation. We are also near this 2021 level before we had a big sell-off. So that does signal to me that once we get this final rally in this wave 5 of this large degree wave C and of A, we could get another big drawdown here in wave B. So that is something we need to be conscious of and remember to take profit, essentially, once we get to our target range. Again, Palantir, all 5 waves have sufficient length to say, okay, it's completed. We did reach our target at about 200, which we had an eye on since back here. I was quite confident that we probably finished wave 4 over here and we are looking at 200, which it did reach. But now I'm a bit worried that this is an ABC wave down and we could have a B wave rally over here before another leg lower. So I'm much more neutral than before. And of course, my view could be invalidated if we get a much higher follow-through action above this wave 5 high. And we can start thinking about the larger degree. Maybe there's another 5 waves somewhere this low. But for now, I remain quite cautious in terms of risk reward. And the big resistance is really here around the 180 level. That will present a big challenge in terms of volume and the 50-day moving average. SOXX, I do think we are going to get a new autumn high before the end of this bull run. And we will probably challenge the 330 level here to finish this wave 5. So for now, I'm just waiting to see how it reacts and if we can get a pullback before as a dip for this the 5th wave. So that's it for this week. Thank you very much. Speak again next week.